Welcome. If you've ever stared at a crypto chart and wondered why price moves feel both random and unstoppable, you're in the right place. Over the next half hour, you'll get a clear, hype-free guide to surviving and thriving in digital asset markets. No miracle claims, no "I turned $100 into a yacht," just lessons forged in real market cycles and trimmed of ego. Let's begin. The real engine behind every cycle. Many people obsess over Bitcoin's 4-year halving, but the main driver of boom and bust is global liquidity, the easy flow or sudden withdrawal of money. When central banks pump cash into the system, risk assets breathe deeply. When they tighten, markets gasp. So watch the dollar index, Federal Reserve balance sheet changes, and broad money supply. If liquidity expands, crypto usually climbs. If it contracts, brace for rough seas. Identify the tide before you paddle. Before planning trades, ask a single question. Is the market broadly rising, falling, or drifting sideways? In an uptrend, the safest move is buying pullbacks. In a downtrend, you sell rallies or stay flat. When price chops in a tight range, the smartest play can be doing very little. Fighting the dominant direction is like rowing against a river. You may make progress, but the current eventually drags you back. Surviving directionless periods, sideways markets grind accounts through pointless activity. Professional desks call it paying for information. If price is stuck and news is thin, reduce position size, trade less, and spend time logging ideas instead of forcing entries. Capital preserved during chop becomes ammo for the next clear move. Measure alts against Bitcoin, not just dollars. Most newcomers chart every token in dollars. Seasoned analysts plot altcoins against Bitcoin to see if they outperform the benchmark. An alt that doubles in dollars while Bitcoin triples is actually lagging. Flip your charts to BTC pairs, and underperformers reveal themselves immediately. A short, powerful toolkit for charts. You don't need complex wave theory. Master 3 things: weekly support and resistance, clean trend lines, and volume spikes that show conviction. Set candles to the weekly time frame. Mark the prices buyers defend each week, and you'll avoid 80% of obvious mistakes. Discovering fresh tokens, or use data sites like CoinGecko or CoinMarketCap. Click the Markets tab and note where a token trades. Hold accounts on more than one centralized exchange. No single venue lists everything. Keep a decentralized wallet as well. Many projects appear on DEXs months before mainstream platforms notice. More access points mean more opportunity, provided you guard your keys with hardware wallets and two-factor authentication. Decentralized exchanges. Early access, not dark alleyways. On-chain swaps look daunting, but are usually a single click from token A to token B. Because anyone can provide liquidity, genuine gems and fatal scams live side by side. Approach them with thorough research, not fear or blind optimism. Understanding price versus value. A coin at 1 cent isn't automatically cheap if supply is 1 trillion units. Check circulating market cap to see what traders can actually buy today. Look at the fully diluted valuation to understand future headwinds as more coins unlock. If only a small fraction of tokens is in circulation, expect selling pressure when big unlocks arrive. The unlock calendar should be if insiders own the majority of supply that releases next quarter. A perfect chart can fall apart overnight. Sites that track unlock schedules exist for a reason. Consult them before entering. Favor projects where a solid portion of supply is already on the market, so the playing field is fairer. Let listings do part of the filtering. Major exchanges still run legal and technical checks. A Binance or Coinbase listing doesn't guarantee success, but it does weed out many outright frauds. Instead of chasing brand new launch pool spikes, scan coins already listed that have quietly dropped 70% and started basing. Odds improve dramatically. Back category leaders, not copycats. Whether the narrative is AI, gaming, or tokenized real-world assets, capital gravitates to the top 2 or 3 names. Copy-paste clones almost never catch up. When a hot niche appears, pick its clear frontrunner early, then at most, one speculative underdog for asymmetrical upside. Narratives outrun fundamentals. Price often responds to attention well before revenue arrives. A meme with viral energy can outpace a technically brilliant protocol that nobody talks about. That isn't a dismissal of fundamentals, it's recognition that markets are voting machines in the short run and weighing machines later. Navigating meme coins thrive because a community gets the joke instantly. Pepe, Doge, or whatever tomorrow's craze is. Treat them like options trades. Limited size, predefined stops, no eternal holding. They behave more like social sentiment gauges than equities, and real-world events can swing them violently, building an information edge. Anything that appears in a public tweet is already late. Private Discord notes, GitHub commits, and unlocked calendars often surface weeks earlier. Good daily routine. Check macro liquidity dashboards, skim project discords for release dates, verify token unlock timelines, and then decide whether that catalyst matters. Each cycle crowns new winners, technology evolves, incentives fade, and investors chase fresh stories. Yesterday's star chain becomes today's heavy bag. Allocate part of your portfolio to promising newcomers with sane tokenomics, but remember to check unlock schedules before committing capital. Attention beats revenue. At first, a project pouring millions into buybacks can still sink if nobody watches. Eyeballs bring liquidity, and liquidity moves price. Revenue keeps a project alive long-term, but narrative and community ignite the rocket. Plan the exit while emotions are calm. Write down a simple framework before euphoria arrives. Example, sell 20% when Bitcoin doubles from your entry, 30% if weekly closes break a key moving average, and the rest by a fixed calendar date, say 6 months after the next halving. A written plan protects you from changing rules mid-flight. Liquidity and flexibility. Yield farms and long lockups can trap you in the wrong place at the wrong time. Stake only what you can afford to leave immobile, and prefer programs with fast unbond periods so you can pivot if the macro picture flips. Keep half the portfolio in majors. Maintaining at least 50% in high liquidity anchors, Bitcoin plus 1 or 2 large caps like Ethereum or Solana adds stability, benchmarks your performance, and curbs fear of missing out on every flashy micro-cap. Taxes are unavoidable. Every trade is timestamped on-chain. Use tracking software to tag taxable events as they happen. Surprise tax bills at the end of a cycle have destroyed more fortunes than bad trades. Closing thoughts? Crypto rewards preparation and punishes impulse. Monitor liquidity first. Respect the prevailing trend. Learn simple chart structures. Understand token supply math. Cultivate discipline in both entry and exit. Follow those principles, and you'll still be standing when the next ecstatic rally collapses into panic, ready to deploy, not licking wounds. Thanks for listening. Remember, nothing in this video is financial advice. Please like and subscribe. It really does help to grow the channel and keep you informed. See you in the video soon.